Could you explain whether Onyx has a specialty approach to managing businesses? Do they lean management, other methodologies they do to enhance value?
Absolutely. So Onyx definitely takes a specific approach when acquiring any company, in that they first of all take a controlling stake in the company, which allows them to improve management and really gain that growth of EBITDA margin, which allows them to get those the returns that they historically have achieved because the EBITDA margin increases. So when they purchase it at a certain multiple, grow the EBITDA margin, and then sell it later, they get higher returns because of that. And they achieve that by sometimes putting people that they know through that extensive network on the boards of these companies, and then start to put in those cost-cutting measures or other measures to improve the EBITDA margin.
And also, for Onyx to be able to initiate some of these cost-cutting measures that others in the industry might not see, it's because Onyx focuses on several very niche industries that they specialize on. So they have a full-time staff just constantly researching this industry, the players, and they make investments in a very narrow range of types of companies. So also, they specialize in corporate carve-outs, and with that specialty, they also are able to realize several types of cost savings that are consistent in the industry because they keep doing the same thing over and over again. And that's what we believe helps drive a lot of the cost-cutting and operational improvements.
I know you're making a buy recommendation despite the risks. Let's go over these risks one by one here very quickly. Governance risk, talent retention risk, investment market risk, even some interest rate risk with their leverage. Which of these risks, after looking at this company for a few months, is the biggest fear for an investor like us?
We believe that out of those three risks, one of the ones that would have the highest impact is the North American economy and how it performs, more specifically the U.S. manufacturing sector, because Onyx has such high exposure to it. And that's because, as one of my colleagues said, Onyx's composition has a lot of proprietary capital in it. So a lot of their gains come from their holding companies. And once again, those holding companies must be able to achieve the EBITDA margins and the EBITDA growth in order for Onyx to perform well. So we believe that if the North American economy is not as good as we predicted, then that is probably the highest impact on our projected target price.
Yeah. To provide a little bit more detail, so like Mike said, the U.S. economy's performance will have the most impact, and because it has the most urgency, so within the next 12 months, how it performs will certainly impact our 12-month target price as well. Succession risk and governance risk, those are more long-term risk where we see that will have less immediate impact, but will definitely have a long-term impact on where the shares and where the companies will go.
Can you tell me a little bit more about some of the unique sources of information when you were doing your research?
Sorry, can you be a bit more specific?
Well, I'm curious well, as an example would be your understanding of the connectedness of management and that particular part. Is that something that you read in the company report, interviewed management about, or where else did you get your
So I guess to do a little shout out to our friends at S&P Capital IQ, there is definitely functionality there where you can see board memberships of specific professionals in the industry. So in order to come up with that network, we did a little bit of a 2 degrees of separation thing to see where management currently has board memberships and where those other board members on those boards also have board memberships. So it becomes a very extensive network through that. So through the connections they have on different boards, that obviously gets them exposed to more people, more professionals, both in Canada, the States, and Europe.
I'm going to add on from a different standpoint as well. So Mike mentioned a bit about how Onyx does corporate carve-outs, and one of the benefits of the network that it realizes and that we actually see evidence of in terms of its acquisitions is that companies often, and management has disclosed this in their conference calls and whatnot, companies actually come to Onyx, companies that Onyx, like in the industries that Onyx specializes in, so in aerostructures, building products, companies actually go to Onyx and say, do you want to buy this division that's lagging in performance, and do you want to buy it and help us improve it? So that's some of the way we see it realized.
When you talked about a favorable fundraising environment for private equity, you showed the pie chart of North American funds and how they are below their target allocation at 58% below target. My question to you would be, why? Why are they below that target?
So I think historically they've been able to achieve returns by investing in several other asset classes, such as fixed income. And because they've been able to generate adequate returns, then they choose not to invest in, I guess, riskier asset classes such as private equity. However, what we see is yields are at an all-time low currently, and also the baby boomer generation is going into retirement. So that's why, with that gap enlarging like what we see today, it's difficult for them not to invest in this asset class. And over the past several years, we've seen a lot of large pension funds like Texas Retirement Fund or the New York City Employees Retirement System putting more assets into private equity.
And I'm just going to add on to that. So another reason we see a lot of them below their target PE allocation is because of the recent recession. A lot of companies or a lot of institutions have been sort of getting out of private equity because of the perceived risk and the fact that there's a lot lower liquidity following the recession. So private equity is known for having very illiquid investments, private investments, and because of that, pensions or institutions try to avoid it after a recession.
So the specialized niche structure that they utilize, do you believe that impacts their multiple when you compare their multiple versus some of their competitors in the publicly traded space? Do the niche competitors have a discount or a premium to the more diversified managers?
Do you mean in terms of acquisition multiples?
No, I'm speaking specifically about them as a publicly traded private equity firm and their strategy being a niche market versus some of their competitors that are a little more diversified in their holdings and the industries that they'll invest in.
Sorry, can you just ask your last part of your question again? So you're saying versus these competitors, what is the...
Right, so of other private equity managers, right?
Yes.
Some private equity managers choose to diversify the industries that they invest in. They've chosen to specialize in a niche manner. Do you think that impacts their valuation whatsoever, given that they're dependent upon cyclical activity?
Okay, so if you're referring to a multiples approach to value Onyx compared to, or to show value compared to something like KKR or Blackstone, so the thing about using multiples with a company like Onyx and comparing it to KKR and Blackstone is there is a significant difference in accounting. So for Onyx being a company that's listed in Canada, it has to report under IFRS. And IFRS requires that companies such as Onyx consolidate 100% of any company that it has control over, whereas in the States, under US GAAP, there's a specific exemption for investment holding companies, which KKR and Blackstone are considered. So really you can't do any sort of earnings-based multiple, even EV to EBITDA price earnings. It doesn't make sense because what you're doing is you're taking all of the operating companies and you're consolidating them up. So if you have a lot of dispositions in one year, acquisitions next year, that income really fluctuates, so we can't really do that. We looked at other multiples as well to see if that was comparable, such as EV to AUM, for example. But because these companies have such different mixes between proprietary and third-party capital, we really also couldn't use those because it would unfairly be attributing all of Onyx's value to their asset management business when that's just not true, because most of their value comes from their proprietary capital.
Right, and just to finish off here, so that slide showed the EV to AUM multiple, which we used to compare Onyx's asset management business to other firms that manage funds. We actually compared to KKR and Blackstone, which was not shown there, but they actually had an EV to AUM multiple of around the 7.7% that Onyx had. Theirs was between 7 and 9%.
How long has the key management team been doing this, Schwartz and his key players? And what's their average holding period for these companies they invest in the private equity side?
So Onyx started in 1984. It was taken public in 1987. Jerry Schwartz has been with the company since inception, and so have several of the other members there. And as we mentioned, Onyx's management team on average has 16 years experience with the firm. So they've been there quite a while. And with respect to your second question, their fund life is about between 3 to 7 years. Thank you.